Hi, my name is Isabella Farr. I'm a senior reporter covering commercial real estate in LA. And here today we have Laura Stumm. I'll get you guys to introduce yourselves before we start. But we have Laura Stumm and Chris Rising. Laura, why don't you start? Just
Sure.
quick introduction.
Testing. All right, my name is Laura Stumm. I'm with Newmark. I handle all commercial real estate sales in Los Angeles for us. We've been doing predominantly office work, so a lot of the headline news trophy office sales that sold in advance of ULA, that was my team. And yeah, Chris is a longtime friend.
There we go. What do you know? Hi, I'm Chris Rising. I'm a co-founder and CEO of Rising Realty Partners. Traditionally, we've been a very active player in downtown office. Since 2019, we've pivoted a bit. We do a lot of industrial, multi-tenant light industrial, specifically from Texas to Colorado to Nevada and parts of California. But we are still a very large landlord in downtown LA. We have been living and dying with this since, I would say, March of 2020.
So I wanted to start with that. Obviously, downtown LA is an office market that is really struggling. In the second quarter, more than 20% of all office space was vacant. That's according to Newmark. Tell me about this lack of demand that we've seen since 2020. Chris, we'll start with you.
Well, I'd say a couple of things. I think if you look at the county of Los Angeles, it's a series of office parks. Whether you go as far east as Pasadena or Glendale or Burbank, or you start to come west and you go through downtown LA, Mid-Wilshire, Sentry City, Culver City, Santa Monica. So we have a variety of office parks. Downtown LA is the only one that has a rail system that can move lots of people, and it's the center of the spoke for the billions of dollars we've spent. And I would say what I think is so sad and disappointing about the leadership we've seen in the last 3 or 4 years, it is also, downtown LA, the second largest concentration of government workers outside of Washington, D.C. There is 100,000 people now live in downtown LA. I mean, that's a pretty big city anywhere, 100,000 people. You have pre-COVID, 500,000 people a day would come downtown. Every day, come and leave. Half of that, government workers. And it is absolutely outrageous that our government, whether it's the federal, the state, the county, or the municipal, are not requiring 250,000 people a day to come into the office. It's gotten so bad that they actually call it, some people are like, are you on hybrid or you work from home? And the joke now is, no, I'm on paycheck day. I only come in every 2 weeks when I get a paycheck. That's how bad it is. So we can go through a whole lot of other things, but I would say when half of your daytime population are government workers being paid by taxpayers and they don't have to come downtown, I think that's terrible. Go ahead.
No, and on the flip side, in downtown LA specifically, if you're looking at which assets from my world's capital market, so on the capital market side, which assets are capitalized to provide TIs and leasing commissions to attract the new tenants, because there is demand. It's not as if there's a massive retraction of demand completely from downtown. Is it? Yes, absolutely. Are most tenants shrinking? Yes. But there is demand. There are leases to be done, but there's a massive reluctance by the tenants to commit to a building if they don't know who their landlord will be. The landlord is the person that they'll be living with for the next 5 years if they're signing a 5-year deal. If they're not able to get their space built out, if they don't know who will be owning the building. Some of the buildings are officially in receivership, others are along the way. It's understanding the capital structure and what will happen for all the buildings in downtown specifically right now is a big driver for tenant trepidation, and rightfully so.
Yeah, I would add to that. I think that is a real issue, that you don't have the hands-on ownership that we've had over the years, which then leads to, are they cutting back on security services or other services so that you're not keeping the part of the downtown community that really needs long-term help away from office buildings, because you don't want to bring one of your employees back if there's a threat to their safety. And that is a real issue still today. So, I mean, there's a lot that I'm negative on about downtown LA, but it's 100% about the leadership we've seen, or the lack thereof. And I would agree with Laura. We have been spending most of our time going to lenders and saying, give us 2 or 3 more years on our loans. Most of them are willing to do that, so we're still in the game. We are seeing tenants come back, but it's been the same evolution that it's been since I got in the business in the late 80s, early 90s, which is every new lease, people are getting smaller and smaller because you don't need law libraries, you don't need reception desks, you don't need that. And I don't think that's going to change in any office. The requirements are going to be smaller.
So I think you've hinted at pretty much every question I'm going to ask, but I'll start with I'll start with trying to get tenants back into the office, because there seems to be this big catch-22 of office landlords need to spend money upgrading their space to get new tenants in, but they don't want to because they're worried that they're not going to get any tenants in. How do you, as an office landlord, grapple with that, and how do you kind of look at that as a long-term owner?
Couple things. So historically, if you had a vacant office building and you built out spec space, one would think that the tenants would come in more quickly. And in the case of downtown LA, if I've got a 1 million square foot tower and I build out a 5,000 square foot spec suite, it will likely lease quite quickly. For a brand new construction building that's in shell condition, usually we would recommend building out a portion of that space to lure in the new tenant who may then want to take the entire building. Right now, because all of the new construction is essentially underwater, there's a reluctance to put good money after bad. Doing a cool polished concrete floor with a couch is not going to get the next Google to take the entire building. So that's it. It's just a demand problem more so than building out a perfect space.
Yeah, I'd say there's a couple things. I do agree with that. Look, interest rates are up 500% from a few years ago. So whatever you're building at, when you go and put a new loan on it, it was underwritten at a 6 cap, and now the markets are saying it's a 10 cap, and your money is 500% more expensive. So I don't see, I mean, the days of $120 TI packages they're just not going to be there because there's no one there to write the check. But I think there's something bigger going on, and I don't know the answer, but I pose it whenever I speak. There has been a psychological shift in how people view office space. When I was a young attorney and then a young broker, on Mondays you packed your workout bag and you went downtown, and I worked on the West Side too, you went to the West Side, and your office was your hub. That was, your whole life kind of moved around that. That's changed dramatically now. Office is not the hub for people, at least at this time. So the question is, what role will office play in our society? If it's what JP Morgan and Goldman Sachs says, and I think office is going to come back because they're saying you have to be in. You're hearing that from Google. You're hearing that from Amazon. I think you're hearing it now from a lot of the large law firms. But we've had 3 years where people were told don't show up, so it's hard to look and say there's a ton of demand. So we have to get through this. I often say all we need is what's the new Friends? What's the new television show that's going to get all the Gen Zers to say it's cool to be downtown? Maybe that'll do it. I don't know. But we have this, and our company is also affected by it. We traditionally have been a downtown office landlord with lots of projects, lots of personnel downtown, and now we're a national, partly office, partly industrial, and we have people all around, so we don't need as much office space. So there's this psychological issue that I don't think has been figured out. But I will say this. Just spend 5 minutes on a Wednesday in Sentry City, and you see that office is getting used. And it's getting used in ways that it used to be used. Is it because it's safe there? I think that's part of it. Is it because you have businesses that rely on mentorship and people having human interaction, like the talent agencies or the private equity? I think that says a lot. So there are examples. I was just in Midtown Manhattan. I mean, or Midtown kind of right where Blackstone is. It's on fire there in terms of the office. So, the bars are all busy. So there's glimpses around the country where I can see things coming back. My hope is the Olympics. My hope is the World Cup. Quite frankly, my hope is we just put some real police on Metro so that people feel safe, because the most unsafe places are right outside metro stations. If those things happen, and people start saying, you know what, I'm 24, I want to learn in an office, which I think is going to be the case, we'll get through it. But I had Bill McMorrow described to me, Bill is someone I really like, been a friend forever, from Kennedy Wilson. He said, Chris, most recessions are 2 or 3 years. You got to think about this like World War II. That was 5 or 6 years. And so we've had COVID, and now we've had the interest rate, probably going to have a recession. I don't care what anyone says, I think we're going to have a recession. So it's probably going to be 5 or 6 year turnaround in the cycle. So you just hope you can play long enough.
I'm going to bring it back to Sentry City because it's an office market I wanted to talk about because it is doing exceptionally well. J&B Realty is building a massive office tower there, and it's not even opening until 2026, and the majority of that building is already leased. And that's, a pretty big, shining, bright spot in the office market. What is it about Sentry City that makes it so successful? And actually, I'll do a part 2, so answer that
Sure,
first.
so on Sentry City really has been a bright spot. Now, a couple key themes of Sentry City. You've got, really, it's 2 streets. It's a smaller office market. You have a predominance of Class A, newly built product, a concentration of law firms, finance firms. Obviously, you have the CAA and the talent agencies, which is a driver. You are on the west side, so it's somewhat centrally located. The Westfield Mall renovation is a big driver. So you've got walkable amenities, safety. Safety is the key there. And tenants, I think Sentry City represents all of the wonderful things of the office. You go to the office, you collaborate, and you touched on this before. The most important part of the office is collaborating with your peers. It's not the ping pong table or the soda machine. It's learning, mentoring, growing, and that happens in any office. But in Sentry City, it's really the lack of crime and the walkability that's been important, and the stable ownership. So I was with DECA yesterday, which is it's basically a group that capitalizes Germany. And they basically said to us, look, we're looking to expand. We'd like to get into LA. Take us to what can we buy in LA?
Looking to buy an office building.
Looking to buy an office building, correct. And we canvassed the market. Immediately, everything that's not on the west side is eliminated. They focus down then Class A only. Okay, so that eliminates a lot of Beverly Hills because it's older inventory. They like 20 years and older or newer. So I'm looking at Playa Vista and Sentry City, and those are really the only 2 markets that have those dynamics. So if you were a core buyer coming into LA, wanting to buy a core asset, Sentry City and Playa are 2 of the 2 markets that give you that dynamic. The ownership in Sentry City, 100% of all of those buildings are long-term owners that are not going anywhere. Low leverage, very well-capitalized groups. You want a TI package, they can give it to you. Leasing commissions are no big deal. So it's stable. It's the perfect. It's probably the strongest office market in the country right now. On the flip side, if you're looking at Playa, which would be my second option for new product, you've got so much tech that's there. And in 2020, 2021, there was such an overexpansion of tech into particularly Playa that you had a space grab. And in many cases, tech has taken space that hasn't even been built out. So you've got this, sure, it's maybe 30% vacant right now, but there's this shadow vacancy of, tech swings any which way. And if it goes the wrong direction, that market could have some trouble.
I think that if I could understand, if it was just as simple, which I think it is, a lot of it is it feels safe and it's clean and they're newer buildings, that would be cool if that was just as simple. But we have other markets like Pasadena that have some newer buildings, totally refurbished buildings. That market's on its heels. Burbank, same thing, even though they got all those entertainment tenants there, but it's a very soft market. The one, El Segundo, the part near Manhattan Beach, fantastic office market, long, stable ownership. But I'm not understanding the psychology of why Pasadena wouldn't be on fire. You got a lot of wealth there, very close, people can live there and drive. So I'm not sure yet. To me, I think it's still the psychological of I can work from home. But there's also one other little dynamic when it comes to office. And to me, it's that all those shops that rely on office tenants every day have gone away. So what I mean, chicken or the egg? We're going to get a few new shops, and then people will say, hey, I want to go here because I don't know. I can't. If I knew what it was in downtown LA, I would tell you we would be doing it. But so far, to me, it's just safety. It's just safety, cleanliness. If we bring those things to downtown LA, I think it'll make a difference. But that doesn't answer why Pasadena is so soft.
Got it. So I wanted to switch over to investor appetite. You just mentioned DECA, but obviously this lack of demand has had a huge impact on valuations. We've seen towers in downtown LA trade for $150 a square foot, previously trading at $400 a square foot, so huge drops in valuations. We've seen some appraisals come in at lower estimates. Can you talk about that? Tell me what you're seeing.
Sure. On the investor side, the investor of an institutional office building today is completely different than the investor of 2019. In 2019, if I took let's say I take out US Bank Tower in downtown, collect bids, you're dealing with Goldman, JP Morgan, Hines. These are institutional groups that have a bucket of money for office. Today, those same groups, that bucket of money exists. So when we hear the dry powder on the sideline, yes, there is an allocation, but it's not necessarily for office. And if it is for office, the metrics have to be near perfect. And we did bring out an asset in Playa Vista that was near perfect, so physically excellent. Rent roll had a couple tweaks, and there was WeWork in the building, and there was roll in the first year. And every institutional buyer, A, was the only building I've taken out in the last 2 years where institutions looked at it, so there's that. B, the two problems in the rent roll, the buyers looked at it so punitively that pricing came in dramatically below where it made sense to trade. So the liquidity for these buildings has 100% come from family offices locally, and in a small way, family offices internationally. And those groups, they look at buildings very differently. They underwrite very differently. Institutions underwrite with specific metrics. They're using Argus. You're doing a DCF going forward 10 years. You're running 10 sensitivities. It's a much more scrutinized way to underwrite a building. At this point, the values are so much lower that family offices are generally looking at this back of the envelope, price per pound, 10 to 50-year hold. There's a lot more latitude for error and a lot more scrutiny on all of the individual assumptions. But also the pricing is about half.
Yeah, I think Laura hit it on the head. I would tell you in 2019, my partner and I had put together a $750 million ESG, but really focused on carbon reduction fund. We had our initial investors. I was in New York City on March 13th, 2020, called my partner and said, there's something happening in New Rochelle. This may not be good for us. And a week later, every investor pulled out. I don't think it's possible right now to bring institutional equity to buy an office building in any major CBD, whether outside of New York. And I don't consider Sentry City, the center of a
Nothing's for sale in Sentry City. Everyone wants it. Sorry.
But I'm just saying, there's no money out there. I can't go to CalSTRS or CalPERS. I can't go to an institutional fund. Nobody wants it right now. So it's a very depressing fact of life, but I'd rather be a realist about it. To me, it reminds me of the early 90s. I mean, I grew up with a father in the business, and he was very vocal. I remember in 1989 and 1990 saying, in 91, 92, stay alive till 95. That was the big mantra that he and his partners, Rob McGuire and Jim Thomas, and they all had. And it feels like right now in the 90s, Sentry City came back first, then some of the other suburban offices came back, and then eventually rents got so high, downtown became attractive. You got some new ownership buying, one of the nicest projects in downtown LA, the old B of A, which is now Paul Hastings. Commonwealth has done a great job, but that was owned by Shua, that let it, where if you were in that office building, the elevators were unsafe, but then a couple groups, but Commonwealth now owns it, and it's really nice. I think that's what you're going to see. You're going to see prices skyrocket so much on the west side. Drive times are going to double and triple, and then all of a sudden people are like, hey, you can be in downtown for like a quarter of the price, And, some people can take the train in, and you might want to live downtown. But the problem is that's not going to be in 6 months. It's not going to be it's going to be 3 or 4 years. It's going to be when we see the Olympics. The Paris Olympics will happen. Everyone will get excited. We'll have 4 years of the Olympics. And I don't know if you all noticed, but when the All-Star game came and when the Super Bowl came to LA, boy, a lot of those housing, those homeless encampments got cleaned up. There were a lot more cops driving around. There was a lot more presence. And I think with the Olympics, that will happen. So that's my prediction is downtown will have to be relevant over the next 20, 50 years because we put billions of dollars of transportation money there. But until our elected officials start acting like they should, and I think it's 2 or 3 years before you see anything in downtown LA that is anything like it was in 2015.
So on the topic of financing, I think we can't really talk about downtown LA without mentioning defaults that we've seen and big delinquencies. Brookfield has defaulted on $1.1 billion in loans connected to 3 office towers. 2 of those are in receivership. And it goes back to the point about not being able to refinance, right, given rates are higher. Tell me about that. Tell us, I guess I just gave it away, but tell us why we're seeing these defaults on the rise and why kind of owners are stepping away.
Do you want to see a grown man cry in front of everybody?
Personal experience.
I'm sorry, sensitive.
It's just the reality. It's math. It's just math. We bought something at $450 a foot with 3% interest rate, locked it in for 5 years. Everything felt great. The cap rate was 6%. Now you get it appraised. They're using 10 cap rates. Interest rates are 7, 8, 9%. Sometimes some of it is hard money, 12%. You're not going to put new capital after that. I do believe that if you have occupancy, you can get through this because there will be lenders, and we have lenders who are working with us. But it's the hardest argument I have, especially when I'm doing it over 12 time zones, to say this is not bad money if we get this building to 80 or 90% or 95% lease. The lenders will work with us, but it's a hard, and remember this, some of these deals we did 5, 6, 7 years ago, everyone I did the deal with is gone. They don't own it anymore. The person at whatever pension advisor has moved to the next pension advisor. It's just really easy to blame it on the old person. And that's what they do. And they move on. And this is my 3rd cycle of this, even though it's my 6th in my lifetime. And it's unbelievable how I go talk to servicers. These are all people when I was at McGuire Properties that I was talking to servicers about all these same buildings. Not one person is there who was there in 2010 or 2011. So what's going to happen? We're going to see a lot more defaults. Bases will go down. Then people are going to say, hey, my rent, you don't need to pay $60 over at Sentry City. Come and do a deal here, and we'll charge you triple net 15. And that'll be what brings it back. But it's a lot of pain. It's a lot of pain. And it just goes to show you these business plans. So when they work, you're the smartest person in the world. And when they don't, people come after you. And that's the world we live in. So have broad shoulders.
But then on the flip side, as we're starting to see lenders look ahead, and there are buyers and lenders working together when there is particularly this is more relevant for office. Every office building is underwater. Likely every office building that had a loan put on it within the last 5 years is near or below the loan balance, even if this was 65% LTV. So there has been, at least from what I've seen, what lands on our desk is there's been a collaboration between the two. Hey, I'm not going to default. The equity is still paying the property taxes, but there is, and we've seen this happen more so post Labor Day. So there's been, on the banking side, let's go through our list of issues and let's start chipping away at buildings and just clear them. We have a building on the market right now in Glendale. The client bought it for $144 million. The loan was $94. We're probably going to clear it for $65. And this was take it out, make a market.
Can I have that scoop?
Go. Huh?
I said, can I have that scoop? I'll write it up.
Now, on the flip side, the great silver lining there is we had 10 bids. So there absolutely is an all-cash market out there. It's 100% private family offices, but there are active groups that are looking for a quote-unquote deal. And these aren't guys that are underwriting really sophisticatedly, but they're saying, hey, if I hold this for 5 or 50 years, I think I'm going to do okay at, sub $200 a foot.
I mean, the Union Bank Plaza, which I mentioned before, that was funded with private capital. The acquisition.
And financing these. So these were all cash deals. On the financing side, there's a very active hard money private lending market out there that's really been the lifeblood of some of these deals, particularly the ones that needed to close quickly right before ULA. And had the regional banks not all gone sideways, literally March 15th of 2023, was it this year? God, it feels like 4 years ago. We would have been provided liquidity by all of the regional banks, but those banks were suddenly not an option. So the only other option for liquidity is either SOFR 600, so you're paying 12% at 55% LTV, which is not great, or you're going hard money lender, recourse loan, 70% LTV, also at 12%. So there is definitely, I would say, the Taft Building, 801 Grand, Canvas in Orange County. There's 5 deals within the last 6 months that were all funded by hard money loans in the private community.
Chris, you mentioned this idea of like a new basis, right? Do you see this as an opportunity for opportunistic buyers to come in and for a rent reset in the future?
Well, that will be how it plays out. It won't be Rising Realty Partners, I'll tell you that. We have these leasing calls on our stuff in Las Vegas on multi-tenant light industrial. That's the greatest business it's fantastic. So, no, I mean, I'm not saying we wouldn't get back into it, but the knife is still falling. And I don't know if it's almost at the floor but I know it's still falling. It hasn't bounced back yet. And there's going to be a few more very high-profile downtown LA assets that trade. I think you're going to start seeing TI packages shrink to almost nothing because there's no money there. There's 1 or 2 landlords outside of ourselves, our buildings. We did try to get ahead of it. We saw it coming, mainly because we had a front row seat on one of our assets. And we've got capital, but we're pushing back hard on, I'd rather just tell the broker, here's your money, you can see that in an account, but your TIs are going to be half. And that's, we are back to the days where brokers are asking landlords to escrow TIs that are 2 and 3 and 4 years out. I know one deal where it happened, but most deals it won't because someone has a loan coming due. They're not going to escrow money after they give back the keys, So, as I said, I think it's going to be a rough few years. I think there's going to be lots of opportunity, but until we as a society decide the importance of an office in one's life, which I don't think it's been solved yet, it's going to be a while.
One thing that's interesting to me is that there have been, 2 major receiverships, but not a ton of actual foreclosures. And I've heard a lot of chatter about, no bank wants to hold these assets. Can you talk a little bit about that?
Well, the receiver wants to hold it, especially if it's a CMBS, because they get a ton of fees. It's the biggest problem with the CMBS system, is it's incentivized for Fortress and all these others who own these shops to just take fees and not make a transaction happen. And so the ones that are owned by banks will trade. They'll put in a receiver they'll say, we need to get these off our books. I do think, to me, it's going to come. We're going to have some sort of TARP, if anybody remembers TARP from the GFC, because if you won't send your people back to the office and force them to go to work, I guess the only other thing you can do is use taxpayer money to put together a pool of money to buy a lot of these assets at discount prices, get new ownership in there that's got capital, can make some refresh to buildings. But my prediction is you will see in 2024, whatever the new version is, and you'll see Blackstone jump in, you'll see Oaktree jump in, and they'll pull a bunch of money to go buy these assets, a little bit like the RTC, but a little bit different. Because there's just some of them, there's just no hope. I mean, I don't even know what to say. There's no way anybody's going to put money into a building that they're underwater, significantly underwater. If they're slightly, like a couple of ours, the reason we got the lender there is we're just a couple lease deals away. We feel like where they're located, and the lender's like, we'll write it out with you. And we're putting in new capital, and they're putting in new capital. But I think all the Brookfield stuff, their investors have said, no, we rode this for 12 years. We're not doing it. And so I think, nothing, by the way, I think Brookfield's a phenomenal company, phenomenal operator. I do not claim to be smarter or brighter. I'm none of that stuff. These are good people, smart people. It's just the timing couldn't be worse.
And not throwing good money after bad.
Yeah, they got to be good investors.
There's also two categories of loans. So like the CMBS loans, it's all public. You're getting, the public is reading it, and when it finally hits the quote unquote foreclosure, that's one step in a very long process. What we're seeing the banks do is be more pragmatic, jump ahead of it. If an asset, and this is worth just being aware of, if an asset is in the city of LA and the transaction structured as a deed in lieu, then there is no ULA that's due. So there's a lot of jiggling around to try to figure out how to avoid the ULA tax, because if I'm losing 50%, I'm losing my equity, the lender's taking a haircut, I then don't want to pay 6.06% to the city just because I've lost the asset. So if you structure it as a foreclosure, as a deed in lieu, then you can avoid that.
Yeah, deed in lieu is going to be the way these things are handled. They're not going to pay, or you sell it to the state. I mean, it's interesting because as angry as I am that government workers aren't coming back to work, probably the largest 4 tenants in the market right now is government looking for long-term space. So I don't understand it, but that's how it came back in the 90s, was government led the way and then by leasing space. So
I wanted to talk about Measure ULA, which we'll get into more this afternoon, but how is that putting pressure on the office market too? I've heard that it's kind of tough to gauge whether it's 100% interest rate rising, rising interest rates, or if it's Measure ULA, but talk about the impact there.
You go first. You've got exactly.
The impact is it's the stupidest piece of legislation I've ever seen in my life.
Ditto.
And it just shows that people who don't know how to work hard to earn a living, that is capitalistic and entrepreneurs, are running our city, and it's outrageous. Now, is it in Culver City? Yes. San Francisco? Yes. But I also blame a lot of us who are in this business who kind of didn't really say anything when the push started. And I don't think it's going to win. I don't think our side will win in the courts on it, because even though I do believe the state constitution is very clear that you can't tax people with 50.1% of the vote, I think there's enough loopholes. I think it's going to take us to vote it out. I think there's a strong group. Douglas Emmett and Jordan Kaplan are leading that. There's several others out there who are leading it. But let's be clear what it is. It is a small business tax. It's the next round of people will always be, okay, we'll write the 5% in. But you know who it's killing? It's the person who has a car shop and they own their real estate and their business is their tenant. And this was going to be their nest egg. Or they went out and they bought 20 units and they've been taking care of those and they want to give it to their kids. That's who it's hurting. It's an outrageous tax on small business. And it's hard when we don't have people be very honest about what it is. And it's taking away some of the things that make California great, which is entrepreneurship, thinking, hey, I can start a carpet cleaning business. Let me go out and start one. I'll buy my own building. I'll get an SBA loan. And over 20 years, that becomes worth $20 million. And that's going to be my retirement. And they're just taking a quarter. 5-6% is a lot on this stuff.
But it's also 6.06% on each flip. So it completely disincentivizes a buyer to come into a value-add asset. I have a terrible vacant office building. In 2019, I would have value-add capital come in, invest $10 million in the building, completely renovate the asset, lease it up, and then flip it. In 2023, I will never have an institutional group operate that business plan, because they're hit with 6% on the buy and then 6% on the residual. And this completely doesn't work. For land, it goes all the way down to land too. All of our resi developers, they can't make resi development pencil because they're getting hit on their land basis and they're getting hit on their residual. So you're completely disincentivizing any developer, any value add group from making the city better. And then on the flip side, as all of these assets start to trade at lower and lower values, the appraised value and the value off of which the city's collecting taxes is going down in a dramatic way. So it was extremely just short-sighted.
I think it's worth noting, too, that Measure ULA was advertised as a mansion tax, but it overwhelmingly affects commercial sales. I actually broke the news to a broker one time. I was like, oh, how are you thinking about, Measure ULA? I had just found out, and he was like, it affects commercial sales? This was like a long time before it passed. Yeah, I think that's an interesting note, too.
Well, how long before an average price home is $4 million or something? I mean, I hope it doesn't get there, but it'll get there. I mean, it's just not everything is a $50 million mansion the way they wrote it. I mean, and by the way, to do that $50 million mansion, somebody took risk and they provided a ton of jobs. Those jobs aren't going to come back. I mean, it's ridiculous.
So we've talked about a lot of negative things, I would say. What are some of your...
Welcome to my world every day.
What are you hopeful about?
I will say we collected bids on, I've been dealing my buyer pool has gone from 100% institutional to 100% family office. And I was expecting 3-4 bids on a deal in the commercial side. In this point in time, one bid I'm over the moon. And we had 10 bids. So it was it warmed my heart, honestly, to see the bid matrix and to understand, look, there is a market, there is a floor. I know where it is in downtown, although they haven't been as many trades. I now know where it is on the west side, although again, there haven't been the trades, because once we make that market, it's at a level that you don't want to see, so it's not going to trade. But in suburban office here in Glendale, there's capital out there, all cash capital out there. It's just, it took a while to get here, but it's here to stay.
Well, I know it'd be hard to believe it the way I've talked today, but I am an optimist by nature. So I believe in human beings. I believe in entrepreneurialism. I look around this room and I see people who make their living on commission, so I know how tough they are and how resilient they are. I also believe that real estate, my dad said it all the time, it's real estate cycles. They're cycles. So we're in a down cycle. I remember the early 90s when there were shootings in Westwood and downtown LA was crime-ridden and all that, and we came back from that. We'll have new leadership because people in this room are going to vote in new leadership. Because at this point, we don't have a choice. We've got to be vocal. We've got to be active. And by the way, I'm so tired of the binariness of it all. It's like, you're either pro-business or you're against the homeless. No, these are tough problems. We want to solve all of them. But we need a voice. And I'll tell you, we stubbed our toe on ULA. Our company included. Our company gave some money to the effort at the very end, and I just didn't think it was possible that people would vote for a tax like that. Boy, was I wrong. So we got to get active, and I think that's what will happen. Leadership wins, and I think as many things as I wish our former mayor would have done better. The one thing he did do is he went and got those Olympics. And LA is going to be a different place. From the end of the Paris Olympics next year to 28, people are going to get involved. They're going to try to make things better because the whole world is going to be watching. And so that's the optimism I have.
Well, how are we doing on time? Wrap up? Okay. We can take one question. Is that, yeah? We'll go here. Yeah.
There was talk of adaptive reuse for some of these office buildings in downtown LA. Has that taken off at all? Changing to multifamily shell houses.
God, I ended on such an optimistic note. Now I'm going to go back.
You're hitting a personal chord for both of us.
If you read what this city is proposing, it's silly, it's stupid, it has no ability to drive adaptive. We need to have adaptive reuse. That's what saved the historic core. But right now, the best thing I can say about it is that they're not going to require you to have parking. There's nothing about lowering costs. There's nothing about making it simpler to get things approved. I mean, part of it is you go to building safety right now, there's like 4 people in it. There's 100 people, 200 people in line to get a permit, and there's like 4 people working there. So, I hope they get on it. I do believe that will be a driver of the C office, which I think will be important. But, you look at our city council right now, there's just not that much leadership, but mainly because I don't think they understand the issue. It hasn't been presented to them in a way that this will drive jobs, this will drive redevelopment. And I think if we can do that, but we need something. If you look at what happened in the historic core after the earthquake, it only took 13 years for them to pass it. But once they did, that's why there's 90,000 people living in downtown LA right now, because they used historic buildings and made them apartments.
You also 100% need financing. All of those buildings are in, they're beautiful historic buildings, but they're particularly in the arts district. They need significant, if you're buying the building for $100 a foot, you need 200 into the building. So unless you have, you mentioned before, getting a value add building financed right now without a tenant in tow is impossible.
One more.
So, Laura, you mentioned about the family offices are buying the building now. Would you give us an idea about what size of the deal they are making on the family office?
Sure. So I've had, as small as $15 million deal or as large as on our building. Actually, Rosie, I'm working with Rosie on Aon Center in downtown LA. So I have 2 deals in downtown. These are all 160 million. We've had 2 billionaires through. There's actually one more came through yesterday. So I'd say anywhere between 20 million to 300 million would be family office range. There's quite a few family offices, particularly overseas, that are active. And these are organized family offices. Some of them with real estate backgrounds, some without. And so there's been a little bit of an education, but it's a wide range.
Chris, you mentioned that you have to present these to City Council in a way where they would understand it. And real estate is such an important part of the city and all major cities across America. You guys represent 40% of the taxes that the city generates. And yet it doesn't seem like there's any sort of an organization or anybody that's like really advocating for the entire group where it's actually making a difference. Because I feel like it's very fragmented and it's not making any noise. Is there any effort by the real estate community in Los Angeles to organize and actually have their voice matter?
Well, I think, yes, I'd say I think what Jordan Kaplan and his group is doing on ULA is bringing a lot of people together. I think one thing that's changed is we just don't have the personalities in real estate we used to have, where it was, people who could get in front of a politician, go into City Hall, and you can't even meet with a council person in person anymore. It's all on Zoom. So it's changed, but I think it'll have to change, because wait till we see the budget next year. This is what I say to everybody. It's like, okay, we're going to have 2,000 more cops. We're going to have you've had no transactions. You have no property tax. Nobody's selling a home. Nobody's doing. I mean, where's the money going to come from? And it's going to be dramatic, and that'll be a driver. I think. I think you'll see business people say, you know what, I'm going to run for one of the city council seats amongst all these cities. But I would say right now, outside of the effort around ULA, it is ULA, Urban Land Institute, a few others, BOMA. They're pushing, but we don't have a lobbying effort by the real estate industry within the city of Los Angeles or even the county.
And on the flip side, when you take downtown LA, which is now owned predominantly by Brookfield, and you change that to a scattering of random family offices with and without real estate experience, you don't have that union mentality where you've got a collective group that can go fight for itself. So I think it's going to become more fragmented and more difficult to do that.
Well, thank you. I think we're out of time, but thank you both so much. I appreciate it.